us, I just be taking us the basics of Forex, what Forex is all about, and you can leverage on this opportunity to better your financial life. So let's dive straight in. So there are some terminologies that we have to actually explain before we can get going in this. And the first one is the word Forex itself. So let me start by explaining what Forex is. Forex is, let's start with Forex market. Forex market is a market whereby we exchange two currencies. That is where we exchange one currency for the other currency. So that's what Forex market is all about. Then Forex itself is the act of exchanging one currency for the other currency. Let's say, for instance, I'm in Nigeria. I want to travel to the United States of America, for instance. Once I get to the United States of America, I have to exchange my Naira for what? The United States dollar. So that's the act of doing this is called what? Foreign exchange, which for short is called Forex. So moving on, the next terminology I would like to explain here is called exchange rate. Exchange rate, I know you probably know the meaning of exchange rate, but just to like expatiate more on it, an exchange rate is the relative price of two currencies. Let's say in Nigeria now, we already know the current exchange rate, which is like 1,000 naira to $1. So moving on from this, I'll explain how we make money from the foreign exchange market. So traders of the foreign exchange market make profit from it by what? Exchanging one currency for the other currency. That is the differences between the two currencies. That's what makes profit for traders. So say, for instance, I invested in a pair called USD Nigerian Naira, because every time we trade on Forex, we always pair two different currencies together. You can't see us trading just one currency on the foreign exchange market. We trade two currencies, that is, we pair them together. Say, for instance, now, I want to trade USD now. I pair the two of them together. Then I make money on the differences between the two currencies. Let me give a layman's definition for that. Hope you guys can hear me. Daniel?
Yeah, I can hear you.
So in a layman's definition, I want to use these abokis that change naira for dollars to naira for us. If you take, for instance, $100 now to an aboki man to change for you, let's say the current exchange rate was 900. The aboki man is going to use a rate lower than 900 for you, in the sense that he wants to make profit also from it. So what he does is he buys the dollar from you at a cheaper rate, then he waits for the price of dollar to increase or rise before he sells it and make extra profit from that. So take, for instance, if he bought the dollar from you at the rate of 890 naira, for instance. Please, can you just give me a minute? I want to admit someone on the call.
Yeah, sure.
Okay. So basically, I have to start all over again because of the new person. I hope you don't mind, Daniel.
Oh, it's fine. It's not a problem.
Okay. Good afternoon, everyone. My name is Ibrahim Gbenga, as you all know me, and this is a Forex beginner class for newbies in Forex. I'm not actually saying you guys are newbies, because I know probably you guys might have heard of Forex before and probably done your own research, one or two research on that also. So I'll start mainly by explaining some terminologies in Forex, just the basic ones for now, because this class is a 3 series class. We'll be taking one every week for the next 3 weeks. So this is like the beginners stage. Subsequently, we'll be diving deep further into the whole thing. But today we are just going to take the preamble of everything. So I'll start by explaining what Forex market is once again. The Forex market is a market where we exchange currencies, where you exchange two different currencies for the other. And what is foreign exchange itself? The word exchange itself implies that exchanging two things together. Let's say, for instance, now, in Nigeria, I want to travel to the United States of America now. I can't spend my naira in the United States. I have to exchange that naira for dollar. So me doing that, it means what I've involved myself in what's called foreign exchange. So, and this takes place virtually every day. The foreign exchange market is a 6 trillion per day market. That is, if you value all the transactions that takes place in the market all through the day, all through 24 hours, it is worth $6 trillion. So we as retail traders, we call ourselves retail traders. We as retail traders, we position ourselves in the market to make our own share of this $6 trillion. So I'll go further by explaining the next terminology, which is called the exchange rate. I hope you can hear me, bro Paul. Mr. Paul Owolabi, can you hear me, please? I think he's on mute. I want to know if he's following us. Sorry for the delay. I just want to know if he's following us so he doesn't get left behind.
I think he can hear us because he's chatting.
Okay.
But maybe there's something with his mic. I'm not sure.
Okay. Let me see. I think he can hear us. Okay. So let's just move further. Okay. He has replied me. Let's move further. So as I said the other time, the foreign exchange market is a 6 trillion volume market in every 24 hours. So as our retail traders, we position ourselves through our brokers. We have brokers that place our trades in the market for us. So we capitalize on this and make minute money. You can call it minute. Well, the reason why I'm calling it minute is if you compare what we are actually making from the market to the whole volume of the market, it is actually very small. So going back to what I call the exchange rate. Exchange rate is the relative price of two currencies. That is the rate at which I exchange one currency for the other. Say, for instance, we're in Nigeria now. We all know the current exchange rate is like 1,000 or I think 1,100 also presently. So I want to explain how we leverage on this to make money in the market. And I always like to use the layman's definition that we all know in Nigeria, which is these abokis that change dollar for us to naira. Say, for instance, I have $100 with me, $100 notes with me. I go to the aboki man. I want to change it into naira. What do? I give it to the aboki man, and if the current exchange rate is 900, I'm not going to sell it to him 900 because he wants to profit from that particular trade. So what it does is it gives me a minimal rate, which is like sometimes 850, depending on your agreement or how you can bargain with them. They give me 850 as the rate. So thereby, on that $100, on each dollar, they make $50. Sorry, 50 naira. Please call him. So that's that about that. So how does the Aboki man make more money on this? After buying the dollar from you, he waits till when the value of dollar rises, let's say it's like 1,000 naira, before he disposes the dollar. So that's how it makes money. The same thing applies to we retail traders, only that when we trade, we are not dealing with physical currencies. Like we are not seeing the bills, like the dollar bills straight on. We are doing what? We are doing it off the counter because we are trading what? With a brokerage firm who places our trades for us on the database. So moving on from this, there are some terminologies in Forex that we ought to understand. And in the course of this, I explained at the start that this is a 3 series class. Today, we are just taking the beginners class, and the previous subsequent classes will be diving deeper into this. So first and foremost, we have to understand some basic terminologies in Forex. And I don't know if you guys have a jotter or something, if you can just like jot things down or something. So the first terminology I would like to explain here is called lot sizes. What are lot sizes in the market? Lot sizes is the particular volume that we intend to place our trade on. Say, for instance, I deposit $100 in my brokerage firm, and I want to trade with the $100. The lot size is how I want the unit I want the broker to remove from my account at a particular point in time to trade. Say, for instance, for every movement in the market, I can set it on my brokerage account that, okay, for every movement in the market, they should take 10 cents. You can do it at your own convenience. Like, you can use whatsoever you like. You can set it to be like what? $1 per every movement in the market. And another terminology I like to explain in the market is called pips. Pips is the unit of measurement in the market, PIPS. You can write that down also. It is the unit of measurement in the market. That is, for every movement in the market on the chart, I know most of you might have seen the charts of this Forex thing. So for every movement of this candlestick we see in the market, it is measured in pips. So lot sizes and pips work hand in hand in the sense of I can set it on my account that what? For every pip movement in the market, a particular lot size should be taken from my account. So let's say, for instance, if I'm using 0.01 lot size, this shows that what? For every pip movement in the market, 10 cents should be taken from my account. That's if I'm losing money. But if I'm gaining money in the market at the same time, for every pip movement in the market, if I set 0.01, it means what? I'm gaining 10 cents. I don't know if you guys can get that. So that's basically what I want to explain. And I've not explained brokers to you. Brokers are the intermediaries between the retail trader and the Forex market. Brokers are the intermediary between the retail traders and the market, in the sense that our money are too small to trade in the Forex market, because those who ought to trade the financial markets are the big players. That's people who can bring like $1 million into the market, $10 million into the market, $100 million into the market. We call them big players. But as a retail trader, you only have like sometimes $50 to trade, $100 to place trades and all that. So on a good day, we are not allowed in the marketplace to trade directly. You understand? So the intermediary between us and the market now is what? They are the brokers. The brokers take our own minute capital, and then other traders who also want to place trades in the market, then they compute everything together, then place it in the market for us. So that's basically what broker is all about. So moving on, I would like to probably share my screen coming. If you guys can just give me a minute, let me load my trading view. Load my trading view. screen. Can you guys see my screen?
Oh, yeah, it's coming up. Okay, yeah, I can see it now. So
Okay.
just to be clear, the difference between the pips and the lot sizes. The lot sizes are what you want to trade with, what you set to trade with, while the pips are the movements in the market, right?
Yes.
All right, I just want to be clear. All right. I
Okay.
can see your screen.
Okay. Do you have any other questions?
No, that'll be all for now.
Okay. What of Mr. Paul? Do you have any questions you can type? I don't know why he's on mute. I don't know. I actually wanted to unmute everyone so it can be an interactive class.
Let
Mr.
me
Paul,
just put myself.
Mr. Paul, please can you unmute yourself? I don't know what's happening right now. Okay, let's just move on. So if you guys can see my screen, I just want to use this as an analogy on how the market works. So every red candle you're seeing, yeah, if you can see my screen, this is GBP This is a currency pair called GBP which is the Great Britain pounds and the Japanese yen. So these are two currency pairs, and currently I'm on the 2 hour time frame. I'll explain what time frame means in our subsequent classes, but just for the purpose of this class, I just want to explain how the market moves and how we make money from the market. So can you see my this crosshair?
Yeah, where those two green and
No, this crosshair, that
red.
this line that's looking like a cross. Can you see it?
Yeah, yeah, I can see it.
Okay, I'll be using that to explain just now. So basically, what this you can see two colors of candles here. You have the red candle and you have the green candle.
I
So
think Mr. Paul is saying something that the host is not allowing me to unmute.
wow. Let me see. Let me go back. Let me go back. I don't know what's happening. I don't know what's wrong with this. Is not my system, so I don't really know how to find my way around it. This is the first time I'm using a Mac, so can't really figure my way around it. Let me see. Mr. Paul, probably I'll get back to you. Let's just, for the purpose of this, let's just continue. I can't see where to unmute you. I don't know. So let's just go back to the chat. Basically, all these red candles. And Mr. Paul, you can send me messages on WhatsApp instead, so I can carry you along. My WhatsApp is just right here by my side. Just feel free to just drop a message for me there. Any questions you have also, you can drop it on WhatsApp. So let's just move further. So basically what you have here is GBP which is Great Britain pounds and Japanese yen on the 2 hour time frame. So all the red candles, there are two colors here. We have the red candle and the green candle. So it's as simple as possible. The red candle means what? Anywhere you see this red candle, it means what? The value of GBP is dropping. That is sell. So I want you to pick up your pen and write some things down, which is bull, bull, and bear, bear, sorry, bull. Then you can write bear also. Then I'll explain these two terminologies for you. So basically, all these red candles you can see on the chart are what we call the bear candle. What does bear means? Bear means selling. That is, the value of something is dropping. The value of the currency is dropping in the market. That's what bear simply means. Why this green candle on the other side means what? The value of this currency pair is increasing in value. The value of this current currency pair is increasing. That's what we mean by bull candle. So anytime I tell you that, okay, you have a bull candle, the bull candle is what? Is the green candle. The bull candle is what? Is the green candle. And the green candle shows what? That the value of this particular currency is increasing. On the other side of it, the bear candle is what? Is the red candle. And the bear candle signifies what? That the value of this currency is dropping. If you can see it on this side, these are the values of the currency at a particular point. Currently, the dollar exchange rate to the British pound exchange rate to the Japanese yen is around 182. That is, for every £1, you get what? 182 Japanese yen. I don't know if you can see that on this side.
Yeah.
So that's basically what it means. So how do we position ourselves as traders to make profit from this? Is there's something we call price action. That is monitoring the actions of price, looking at what price is doing at a particular time, studying the patterns that we see on the chart to kind of like, I don't want to use the word prediction, but to kind of like predict where the market is going to go next. Because you can't actually predict the market. You can predict something now and the market just does what it wants to do, you understand? So basically, we read these candlesticks to kind of pinpoint where the market is going to go. So that's how we capitalize on this to make profit. So for instance, I want to go to Euro USD. There was a particular trade I took on Euro USD yesterday. That was doing NFP. Okay, this is my markup. This is my markup on the yeah. Sorry, I'm not used to using Mac yet though. My hand they shake like this. So take for instance, yesterday, this particular red candle that you're seeing here in the crosshair, I actually took a trade on it yesterday. This sell alone, I used a lot size of about 0.3 yesterday, and it made me close to like 90 something, close to $100, just this candle that you're seeing alone. And how do I know the particular time to sell? I know on the chart, you can see me drawing lines. You can see this line, there's this line, there's this other rectangle box or something, rectangular box and all these things. So these are the tools we make use of in the market to kind of like pinpoint where price is likely to go next. I don't know if you get that.
Yeah.
So in subsequent classes, I'll be taking you on how to read candlesticks, because we have different types of candlesticks. If you can notice, all these candlesticks, they have different shapes. They come in different sizes. And you can see some of them have long sticks we call them wicks. They have wicks at the bottom and at the top. If you can see it. Can you see it, Daniel?
Yeah. Like little extensions.
Yes, on it. So yes, each of these things you're seeing, they have will I say a language, they have an information they are trying to pass to you, basically. So the first thing for you to probably know how to trade first is you have to understand the language of the candlestick. When you see a candlestick that is as long as this, there's something it's telling you. If you see a short candlestick like this one, there's something it's telling you at the same time. Then if you see markets moving sideways in this point, you can see the market is moving sideways, yeah? It's not really down, it's not really going up, it's just moving sideways. There's what it's telling you also at the same time. So in our subsequent classes, I'll be taking you on how to read these candlesticks, then how to probably mark up the charts. You can see I have lines drawn everywhere. If I shift to the side here, you see I have lines drawn. You can see this line, this one, there's this other one, there's this other one like this. So just in the next classes, I'll be taking you on all those ones. But for now, basically, I want you to cross-check everything I just told you now. You know, you have the social media, you have the YouTube and all those things. So you can actually read on it also and educate yourself against the next class. So when I'm speaking in the next class, it won't be like I'm speaking in parables and all that. You can understand basically what I'm saying. You understand?
All right.
Okay. So I'll give you a website where you can actually brush up on the old terminologies thing. Because first of all, for you to learn anything, you have to learn the terminologies, the language that we traders use. So that when I'm talking, you know what I'm referring to. Because there are other things we haven't touched on. We have something called equity. I know you probably have heard about equity before.
Yeah.
Equity, we have the free margin, we have the leverage, we have so many other terminologies. So I'll give you a website now. It is called babypips.com. I'll type it on your WhatsApp, drop it for you now. Babypips.com. Babypips.com. So you can just check there. Then there's a site that you see an option for Forex for new beginners or something like that. You click on Forex for new beginners, then you start reading all those things you see there. You can just read at your own pace, you understand, against our next class next week. So I don't know if you get what I said just now.
Yeah, understood.
Okay, so that's basically that for now. Sorry for the old glitch, and I know everything is not in order like this because this is the first time of me holding a class and I'm just getting myself accustomed to the whole thing. So just bear with us for now. Subsequently, we'll try and improve on our performances also.
Okay, no, it's not a problem.
Okay, so that will be all for now, and I'll see you probably in the next class. Okay.
All right, man.
All right.
Thank you very much. Take care.
Yeah. Okay.